Have you ever noticed how some people seem to come out of every economic crash richer than before, while others lose everything? It's not just luck, it's strategy. What if I told you that the wealthiest people in America don't fear recessions? They actually look forward to them. While the average investor loses 30 to 50% during market crashes, billionaires like Warren Buffett, Ray Dalio, and Howard Marks are quietly deploying capital and building generational wealth in these exact moments. Here's something most financial advisors won't tell you. Recessions don't destroy wealth, they transfer it. And right now, most Americans are positioned to be on the wrong side of that transfer when the next downturn inevitably hits. In this comprehensive guide, we're going beyond the generic, buy low, sell high advice. I'll walk you through the exact economic indicators that signal a coming recession months before the headlines, the psychological traps that cause even smart investors to make costly mistakes, and the strategic asset allocation that has historically generated life-changing returns during market crashes. By the end of this video, you'll have a complete recession playbook that works whether you have $1,000 or $1 million to invest. You'll discover how to protect what you've already built, position yourself for extraordinary opportunities, and emerge stronger while others are still recovering from their losses. If you're ready to transform the next economic downturn from a threat into your greatest wealth-building opportunity, hit the subscribe button and comment "Recession Ready" below. Your financial future may depend on the strategies you're about to learn. Now, let's start by understanding what a recession really is, beyond the fear-mongering headlines. #1 The anatomy of market crashes, beyond panic. Ever notice how everyone becomes an economic expert after a market crash? Oh, we should have seen it coming, they say. The truth is, market crashes aren't random accidents. They follow recognizable patterns that repeat throughout history. When you understand the machinery behind market crashes, they become less mysterious and far more predictable. At their core, most crashes follow a four-stage process: euphoria, trigger, panic, and capitulation. During euphoria, everyone's making money. Caution is thrown to the wind, and valuations disconnect from reality. Remember 2021, when companies with no profits were worth billions simply because they had tech or crypto in their name? Finally, capitulation arrives. When even the optimists give up, headlines turn apocalyptic, and everyone believes the market will never recover. This is precisely when the greatest opportunities emerge. Now, let's explore the early warning signals that can help you identify the next downturn before the crowd catches on. Number 2, early warning system. Detecting the next downturn. What if you could see a recession coming months before everyone else? The wealthy don't have crystal balls, but they do have dashboard indicators that flash warning signs well before markets collapse. The inverted yield curve is perhaps the most reliable predictor we have. When short-term government bonds yield more than long-term bonds, recession has followed within 6 to 18 months with 85% accuracy since 1955. Ray Dalio watches this indicator religiously, calling it the canary in the economic coal mine. During 2019, the yield curve inverted, and by early 2020, we enter recession, right on schedule. Pay close attention to employment data, particularly initial jobless claims. When these claims rise for 3 consecutive months, it's time to get defensive. During every recession since 1970, this indicator provided a 4 to 6 month warning. Before the 2008 crash, claims started climbing in November 2007, but most investors ignored this data until it was too late. The housing market often signals trouble ahead. Watch for declining home sales sustaining for 6+ months, falling building permits, and rising inventory. Robert Shiller, who predicted both the 2000 and 2008 crashes, notes that housing typically peaks 12 to 18 months before recessions begin. In 2006, home sales peaked and started declining, but stocks continued rising for another year. Consumer confidence surveys can give you the edge too. When confidence drops 15% from its peak over several months, prepare for economic contraction. Warren Buffett famously said, "By the time you read about economic trouble in the newspaper, the smart money has already acted." Creating your own early warning system isn't complicated. Set up a simple spreadsheet tracking these indicators monthly, or use free resources like the St. Louis Fed's Fred database. When multiple indicators flash red, it's time to prepare, not panic. What indicator are you watching most closely right now? Comment yield curve below. I'm curious, what has your attention? Now, let's talk about the most challenging aspect of recession investing, mastering your emotions while everyone else is losing theirs. Number 3, the psychology of wealth, mastering your emotions. Have you ever sold an investment out of fear, only to watch it recover shortly after? You're not alone. Our brains are literally wired to make poor financial decisions during market turmoil. When markets crash, our amygdala, the brain's fear center, takes control, triggering what neuroscientists call financial fight or flight. This biological response helped our ancestors survive predator attacks, but devastates investment returns. Studies show the average investor underperforms the market by nearly 4% annually, primarily due to emotional decisions. Charlie Munger, Warren Buffett's partner, puts it bluntly: the first rule of compounding is to never interrupt it unnecessarily. Yet during the 2008 financial crisis, over 45% of Americans sold equity investments near the bottom, locking in losses and missing the subsequent 400% recovery. Developing emotional discipline requires practical techniques. First, create a pre-commitment strategy, a written investment plan detailing exactly what you'll do when markets drop 10%, 20%, and 30%. Ray Dalio calls this playing the game before the game. In 2020, his fund was prepared with specific buy targets when the market hit predetermined levels, allowing rational decisions amid chaos. Second, implement a 72-hour rule for all selling decisions during volatility. Most emotional decisions look foolish 3 days later. Howard Marks saved his clients billions by enforcing this cooling-off period during past crashes. Third, practice information fasting during market downturns. Constantly checking your portfolio or consuming panic-inducing financial news activates your amygdala repeatedly. Many successful investors check their portfolios weekly or monthly, not daily, during turbulent markets. Perhaps most important, reframe market drops as sales rather than disasters. As Seth Klarman notes, the single greatest edge an investor can have is a long-term orientation. When everyone sees catastrophe, train yourself to see opportunity. Now, let's examine the specific mistakes that destroy wealth during recessions so you can avoid them entirely. Number 4, common mistakes, the recession wealth destroyers. The greatest fortunes aren't made by brilliance during recessions, but by avoiding catastrophic errors. Let's look at the most expensive mistakes people make when markets turn south. Panic selling isn't just common, it's epidemic. During the 2020 COVID crash, retail investors pulled over $326 billion from equity funds in just 6 weeks. Those who sold at the bottom locked in 35% losses and missed a historic recovery that took just 142 days to reach new highs. As Peter Lynch famously noted, far more money has been lost by investors preparing for corrections or trying to anticipate corrections than has been lost in corrections themselves. Equally destructive is futile market timing, attempting to perfectly call the bottom. A J.P. Morgan study found that missing just the 10 best market days over a 20-year period cut returns in half. And yet, countless investors sit in cash waiting for the all-clear signal that never comes. Even investing legend Peter Lynch admits, "I can't recall ever once having seen the up-to-the-minute financial world we live in successfully predict a market crash." Excessive debt becomes a death trap during downturns. Many investors use margin loans during good times, only to face devastating margin calls when markets reverse. Before the 2008 crisis, average household debt reached 134% of disposable income, setting up millions for financial ruin when assets declined but debts remained. Perhaps most insidious is what Ray Dalio calls the diversification illusion, believing you're protected when you're not. In 2008, supposedly uncorrelated assets suddenly moved in lockstep. True diversification means owning assets that respond differently to the same economic forces, not simply owning different stocks or funds. The good news? These mistakes are entirely avoidable. Research your potential downside before focusing on upside. Build portfolios that don't require perfect timing. Maintain manageable debt levels. and create genuine diversification across asset classes. Let's now build a foundation that will not only protect you during downturns, but position you to thrive. Number 5, recession-proofing your personal finances. The foundation. Before you can profit from a recession, you need financial stability to weather the storm. Consider this your financial fireproofing. It's not glamorous, but it's what allows you to be aggressive when opportunities arise. First, build your crisis cash reserve. The conventional wisdom of 3 to 6 months expenses is insufficient during recessions when job searches can extend to 9+ months. Ray Dalio recommends what he calls a financial oxygen tank of 12 to 24 months of essential expenses for optimal freedom during downturns. Keep this money in high-yield savings accounts or short-term treasury bills, not investment accounts vulnerable to market swings. Next, create your debt elimination hierarchy. Not all debt is equally dangerous during recessions. High-interest credit cards and variable-rate loans can become financial quicksand when incomes drop or interest rates rise. As Mark Cuban bluntly states, credit cards are the worst investment you can make. His advice? Attack debts in order of interest rate, not balance, focusing intensely on anything above 6%. Equally important is developing multiple income streams. Self-made millionaire Grant Cardone notes, the average millionaire has 7 sources of income. During the 2020 recession, households with diversified income sources experienced 40% less financial stress than single-income households. Start small, a side business, rental income, freelance work, or dividends, but start now, before you need it. Don't overlook income protection. Review your insurance coverage, particularly disability insurance, which becomes crucial during economic contractions when health problems and job losses often coincide. Warren Buffett emphasizes, risk comes from not knowing what you're doing. Proper insurance ensures one emergency doesn't cascade into financial disaster. Finally, practice extreme expense optimization. This doesn't mean living like a monk, but rather identifying your happiness per dollar ratio. Studies show experiences and necessities provide lasting satisfaction, while discretionary material purchases often don't. Cut the latter aggressively before recessions hit. Now, let's explore how to position your investments before, during, and after economic contractions. Number 6, strategic asset allocation. Before, during, and after. Market timing doesn't work, but strategic asset allocation absolutely does. The right portfolio structure can not only protect you during downturns, but position you to capture massive upside when recovery begins. Before recession signals flash, gradually shift toward what investment legend Howard Marks calls defensive quality. This means increasing allocation to companies with strong balance sheets, minimal debt, stable cash flows, and essential products or services. During the 2000 to 2002 recession, consumer staples declined just 13%, while the broader market fell 49%. Build positions in healthcare, utilities, consumer staples, and high-quality dividend payers that have consistently raised payouts through previous recessions. When multiple recession indicators turn negative, increase your dry powder position, cash and short-term treasuries. This isn't about timing the market, but creating buying capacity. Bill Ackman reveals, my best investments came from having capital available when others didn't. During the 2008 crisis, he maintained over 30% cash, which he then deployed to buy deeply discounted blue-chip stocks that later multiplied several times over. During the actual downturn, implement what Ray Dalio calls dollar cost averaging with a twist, accelerating your investment pace as markets fall further. Rather than investing a fixed amount monthly, consider a sliding scale. Normal contributions at 10% down, 1.5x at 20% down, and 2x at 30% down. This mathematical approach removes emotion from buying decisions. As recovery begins, usually while headlines remain negative, gradually rebalance towards cyclical growth sectors that historically outperformed during early economic recovery, consumer discretionary, financials, and industrials. These sectors often lead recoveries with 50 to 100% gains in the first 12 to 18 months of a new bull market. The key across all phases? Consistency, not perfect timing. Warren Buffett's advice remains the simplest and most profound. Be fearful when others are greedy, and greedy when others are fearful. Let's now look at how real estate, one of history's greatest wealth builders, performs during economic contractions. Number 7. Real estate strategies during downturns. Real estate has created more millionaires than perhaps any other asset class, but recession timing makes all the difference. While most property markets decline during downturns, strategic investors find extraordinary opportunities. Contrary to popular belief, not all real estate crashes during recessions. During the 2008 financial crisis, the worst housing crash in modern history, certain markets like Dallas, Houston, and Pittsburgh saw price declines of less than 5%. Meanwhile, speculative markets like Las Vegas, Phoenix, and Miami experienced 50% plus drops. Location fundamentals matter more than national trends. Sam Zell, the billionaire real estate investor who sold his entire office portfolio right before the 2008 crash, follows what he calls a supply constraint principle. He targets markets where building regulations, geographic limitations, or economic conditions restrict new construction. When demand inevitably returns after recessions, these supply-constrained markets recover faster and appreciate more. Financing strategy becomes critical during downturns. Rather than avoiding debt entirely, successful real estate investors lock in long-term, fixed-rate financing when rates are low during recessions. Grant Cardone, who built a $2 billion real estate empire, acquired most of his properties during the 2010 to 2012 period using 30-year fixed loans at historic lows, creating positive cash flow from day one. For individual investors, consider what Robert Kiyosaki calls recession-resistant niches. During the 2008 crash, while luxury condos sat vacant, affordable workforce housing and stable employment centers maintained 95% plus occupancy rates. Similarly, during COVID, suburban single-family rentals thrived while downtown high-rises struggled. The most accessible strategy? House hacking. Purchasing a multi-unit property, living in one unit, and renting out the others. This approach reduces your living expenses while building equity through tenant payments. When combined with FHA loans requiring just 3.5% down, it becomes particularly powerful for first-time investors during recessions when property prices are depressed. Now, let's explore more sophisticated strategies for those ready to take their recession investing to the next level. Number 8. Advanced strategies, options, hedging, and alternatives. Beyond traditional investments lie more sophisticated tools that can not only protect your wealth during downturns, but potentially generate significant returns when most portfolios are bleeding red. Option strategies offer what billionaire Paul Tudor Jones calls financial insurance with upside potential. Protective puts, which give you the right to sell at a predetermined price, can shield your portfolio from catastrophic losses during crashes. During the 2020 COVID crash, investors who allocated just 1 to 2% of their portfolio to protective puts on major indexes preserved 15 to 20% more capital than unhedged investors. The mathematics is compelling. Small insurance premiums can prevent life-changing losses. For those with sufficient knowledge, strategic bond allocation becomes powerful during recession transitions. Jeffrey Gundlach, known as the Bond King, recommends what he calls the barbell approach, combining short-term treasury bills under 1-year maturity with smaller allocations to longer-term government and corporate bonds. This strategy typically performs well when stock markets struggle, and during the 2008 crash, high-quality government bonds actually gained value while stocks plummeted. Alternative investments deserve consideration for their recession-resistant characteristics. Ray Dalio's all-weather portfolio incorporates gold and other commodities as partial hedges against both market declines and inflation. During the 2008 financial crisis, gold appreciated over 25%, while equity markets collapsed by nearly 40%. A small 5 to 10% allocation can provide meaningful diversification benefits. Perhaps most interesting are what Howard Marks calls special situation investments, distressed assets, private lending, or structured investments that become available only during economic stress. These opportunities typically require larger minimum investments and longer holding periods, but can generate 15 to 25% annualized returns when properly structured. The key principle with advanced strategies: start small, get educated, and expand gradually. As Warren Buffett warns, risk comes from not knowing what you're doing. These tools are powerful but require deeper understanding than conventional investments. Now, let's explore how recessions create unique business opportunities that can generate wealth independent of financial markets. Number 9. Business opportunities created by recessions. Some of the world's most successful companies were born during economic contractions. Microsoft 1975, Airbnb 2008, and Uber 2009 all launched during recessions when conventional wisdom said to avoid entrepreneurship. There's wisdom in this counter-cyclical timing. During recessions, what Sarah Blakely, founder of Spanx, calls the opportunity cost gap narrows dramatically. When the economy booms, leaving a stable job for entrepreneurship carries significant financial risk. But during downturns, when job security diminishes and salaries stagnate, this opportunity cost shrinks. Blakely started Spanx during the 2000 recession with just $5,000, eventually building a billion-dollar brand. Recessions also create what Tony Robbins terms necessity innovation markets, customer problems that suddenly need solving. During the 2008 financial crisis, cash-strapped consumers needed affordable travel accommodations, creating the perfect environment for Airbnb's launch. After COVID, remote work solutions, home fitness, and telehealth exploded as necessity-driven markets. For those not ready to launch ventures, recession acquisitions offer compelling opportunities. Small businesses often sell at 30 to 50% discounts during economic contractions. Mark Cuban built his fortune partly through acquiring distressed companies, noting, "Only when the tide goes out do you discover who's been swimming naked." Many over-leveraged but fundamentally sound businesses become available at fraction of revenue prices. Another accessible approach is what Gary Vaynerchuk calls skill arbitrage, developing capabilities in countercyclical industries when demand for talent exceeds supply. During the 2008 recession, digital marketing professionals remained in high demand while traditional roles contracted. Those who pivoted their skills accordingly often maintained or increased their income despite broader economic contraction. For knowledge workers, the freelance economy typically expands during recessions as companies reduce full-time headcount but still need specialized expertise. Platforms like Upwork and Fiverr historically see registration spikes during economic downturns, creating opportunities for those with marketable skills. Now, let's examine how to maximize returns during the often overlooked recovery phase that follows every recession. Number 10. The Recovery Playbook, maximizing the upswing. The greatest wealth-building opportunities often come not during the recession itself, but in the early recovery phase that follows. This critical period, typically 12 to 24 months after market bottoms, historically generates the highest returns of the entire market cycle. Understanding recovery timing is essential. Markets typically begin recovering 3 to 6 months before economic indicators turn positive. This means headlines remain negative even as smart money begins positioning for growth. Peter Lynch calls this climbing the wall of worry, when markets rise despite lingering pessimism. During the 2009 recovery, stocks had already rebounded 30%, while unemployment continued rising and media coverage remained overwhelmingly negative. Sector rotation becomes crucial during early recovery. Historically, financial, consumer discretionary, and industrial stocks lead recoveries with average gains of 25 to 40% in the first 6 months after market bottoms. Ray Dalio describes this as a reflation trade, betting on sectors most sensitive to economic acceleration. Following the 2020 COVID crash, small-cap value stocks outperformed technology darlings by nearly 30% during the first year of recovery. Consider what Howard Marks calls the credit opportunity window. When recoveries begin, high-yield bonds and structured credit often deliver equity-like returns with lower volatility. After the 2008 crisis, many corporate bonds yielded 15 to 20%, and subsequently delivered total returns exceeding 50% over the following 2 years as default fears subsided. For real estate investors, the early recovery phase presents the optimal buying window. Housing typically lags stock market recovery by 12 to 18 months. Sam Zell made billions by purchasing quality properties during the early recovery phase of previous recessions, when prices remained depressed, but financing had become available again. Perhaps most important is psychological positioning. The greatest obstacle to capturing recovery gains is lingering fear from the preceding crash. Warren Buffett articulates this challenge perfectly. The rear-view mirror is always clearer than the windshield. Many investors remain paralyzed by recent trauma, missing the most profitable phase of the market cycle. Now, let's bring everything together to create your comprehensive recession wealth plan. We've covered a tremendous amount of ground on this journey through recession wealth building. From understanding market crash mechanics to detecting early warning signs, from mastering your psychology to avoiding costly mistakes, from building financial resilience to seizing opportunities across multiple asset classes. You now have a comprehensive playbook that most investors will never possess. The most important takeaway: recessions aren't random disasters. They're predictable, cyclical opportunities for those prepared to act strategically rather than react emotionally. While most people see economic downturns as something to fear, you can now recognize them as wealth-building accelerators when approached with knowledge and discipline. Your advantage doesn't come from predicting exactly when the next recession will hit, but from having clear protocols for how you'll respond when it does. By preparing now, building your financial foundation, mastering your psychology, and developing your opportunity fund, you position yourself to act decisively when others are paralyzed by fear. Remember that fortune favors the prepared. The decisions you make during calm periods determine your options during turbulent ones. And the actions you take during market panics often determine your financial trajectory for decades to come. What part of this recession strategy resonates most strongly with you? Which area are you committed to strengthening first? Share your thoughts in the comments. Your insight might be exactly what another viewer needs to hear. If you found value in these strategies, please hit the like button and subscribe for more wealth-building wisdom. The economic cycle waits for no one, and with the right preparation, your next financial breakthrough might be closer than you think.